Emerging markets have had a torrid time this year. The MSCI index of EM stocks is in bear territory, and vulnerable currencies from Argentina's peso to Turkey's lira have tumbled. Nervous investors are concerned the contagion could see the sell-off spread. They're watching for a spark that could light the fuse, from the upcoming elections in Brazil to an escalation of the trade war, or even a stronger US dollar. But analysts argue much of Asia is faring better than other parts of the world. Despite emerging markets being a catch-all phrase, developing economies have diverging fortunes. A key warning sign is a country with a current account deficit where the value of exports and net investment income exceeds imports. This makes countries more reliant on foreign capital, which is at risk of being withdrawn if investors become nervous. 20 years ago, parts of Asia barely had any forex reserves, which left them vulnerable when the US raised interest rates and capital was being pulled out of the region. Fearing a repeat, many countries in Asia have built up huge war chests of FX reserves, which helps them to protect their currency's value. Still, analysts warn that Indonesia's net FX reserves are on the lower side, and they'll be keeping a close eye on India. Central banks in Asia have strengthened significantly since the Asian crisis, and investors say they have more credible policies in place. The Bank of Indonesia, for example, has been very proactive in increasing interest rates this year. This sits in stark contrast with Latin America, where analysts say central banks are more susceptible to political events.